Alright guys, welcome to this free course. Now in this video, it's not going to be like editing or anything like that. I'm literally just going to pull up my screen and just show you straight up from A to B my swing trading strategy. I'm not going to try and make it too long, but also I do want to go into depth, so I'm going to try and be as efficient as possible. And you'll be happy to know this isn't some elaborate course sale at the end. I'm not going to say, if you want to learn more, join my course. I'm just going to straight up deliver. Okay, so I've put a little slide point together. We're going to get straight onto the charts, but yeah, it's just better for structure. Cool. So what are we going to be covering? So we're going to be covering supply and demand 101. That is what I use when I'm swing trading. And really and truly, everything is supply and demand, whether you trade support and resistance, whether you trade ICT. The underlying thing that actually moves the market is supply and demand. You know, it's banks buying and selling at certain levels, and we'll get into it a little bit more. But yeah, and then we're going to go over how to identify supply and demand zones. So actually finding supply and demand formations on the chart. Right now, that might not mean a lot to you, but that's because we haven't gone through the first thing, which is the basics of supply and demand. Then we're going to go over the rules and parameters around these zones, and then we'll go into practical application. So that's me showing you some of my trades, showing you, if I'm looking for a trade right now, basically just going through the entire process. So yeah, firstly, let's start off with what is supply and demand, and more importantly, how do we use it in trading terms? Okay, now in order to understand what supply and demand is in trading terms, right, you first need to understand that banks and institutions are the ones that move the market. Okay. Us retail traders, we don't move the market a single inch, right? We simply don't have enough buying power. So when you look at a chart and you see, especially the higher time frame, right, all of these big moves which are happening, okay, these are caused by banks and institutions. Okay. Now our job as traders, as supply and demand traders, swing traders, right, is catching these moves which are caused by these banks and institutions, and supply and demand allows us to do that. So you can see we've got two zones marked out. We've got a demand zone and we've got a supply zone. Okay. Now, what this is showing us is it's showing us an area in price, right, where a bank has previously bought at. So we can see here, okay, this was our first demand zone. And right now, you don't know why this is a demand zone, or maybe you do, but we'll go into that later on. Okay. So this is where the banks first entered the market. And we can see after the bank entered the market, right, a big move happened to the upside. Then what happened? When price came back into this level, it then went up once again. When price came into this level, once again, it went back up. Okay. So why does this happen? Well, banks and institutions, let me go full screen. So this is actually kind of interesting. So banks and institutions, okay, they are not allowed to enter all of their orders at once. All right, guys, we've got a sponsor for this video. And I know you're thinking, oh, he sold out, but this is not any shit prop firm. This is not any dodgy broker or anything. You know, I have not taken any payment for anything like that on this channel. But Prop Firm Match, I've been using them for the past probably nearly 2 years at this point. And yeah, I genuinely am more than happy to promote them because it's something that I've genuinely been using and it's something that's genuinely going to help you. Okay. Right now it's Christmas. Prop firms are doing a bunch of sales, and chances are you've probably got a bunch of ads that are being pushed to you on YouTube, on Instagram, all of that. Okay, but how do you know when it's too good to be true? How do you know what firm you should actually go with? Prop Firm Match is the place to go. Okay, now with Prop Firm Match, not only can you see the best discounts and everything, but you can see reviews which are 100% verified, not like Trustpilot where they can be faked or anything, from real traders. You cannot fake the reviews on here, okay? You will see that, the reviews on Prop Firm Match are going to be different to the reviews on Trustpilot, and that's because on Prop Firm Match, it's the real people who are putting in the reviews, whereas on Trustpilot, it can all be faked, So yeah, and the great thing is for an example, we can go to, Prop Firm rules, and here you can filter by all of the different rules, you can filter by, let's take a look. So you can filter by the individual firms, yeah. And then let's say we go to funding pips for an example. And then in here, because on their websites, it's always so annoying to understand all the rules and everything, and they try to hide them and things like this, right? You can go here and it's literally got it all broken down for you. So you know exactly how you have to trade, how you're not going to get rejected a payout. And it's basically just all consolidated into one place. Okay. So yeah, you've got everything that you need here. And then you can go to like the favorite firms, specifically on Prop Firm Match, right? So we can see that these are the most favorite firms that everybody is using. And then you can even go to the payout section. You can see how much they've paid out, the number of payouts, the largest payout that they've ever paid out, and, how long it takes. And yeah, it's just got a bunch of cool metrics. You can go to the individual firm, see what platform they use, what payout methods, like literally everything is here. It's just so convenient. And for me, like if I see a really good discount code or something like this pop up on Instagram, first place I go, Prop Firm Match, to make sure that it's actually legit. Take a look at all of the rules and everything like that. And then Prop Firm Match usually have a better discount code than they're even offering like on the ad. So yeah, highly recommend. I've been talking about Prop Firm Match before they even reached out to me. I've always recommended to go to them. So yeah. So if we imagine that they want to enter 1,000 buy orders, right? They first enter the market here. If you imagine this is 333 buy orders that they place here. Now, they're not allowed to enter all of their positions at once. They can't just enter with 1,000, buy orders, because there's simply not enough liquidity in the market. And also, I mean, if they were to do that, it would be pure market manipulation, because they're entering with billions and billions of dollars. So what they instead have to do is they have to wait. They have to average in over time. They have to wait until price comes back down to this level. They'll have resting buy orders there. And then what happens when price comes back into this level? Orders are filled, which moves price higher. So if we imagine 330 orders were filled here. Next time price comes in, another 330 orders were filled here. Okay. Then price comes here, another 333 orders are filled until eventually all of their orders have been filled. Okay. So that is what we are looking at when we see price respecting a demand level. Okay, it's banks and institutions have placed buy orders here. However, they have to average in over time, right? Meaning that they can't enter all of their orders at once. So when it comes back down to this level where they have put their buy orders, of course, there's going to be a reaction. Now, it's our job to identify these zones. So when price next comes in to this zone, we can catch this move on the way up. And we can catch this move here on the way up. Now, on the flip side, supply is the exact same, but the opposite, right? So if we see here, price was moving very impulsive, and then out of nowhere, it absolutely melted, okay? The only entity, like the only people that can make price move in such a dramatic way is going to be a bank or an institution, okay? So once we see this as being created, right, once we see this first supply formation, we know that, cool, this is an area that banks want to sell at. So next time price comes into this level, well, what's going to happen? More sell orders will be filled, right? And we can see that once price comes into this level, it then goes down a little bit lower, it comes back, and then it even goes down much lower, okay? So that is the basics of supply and demand when it comes to trading. And essentially, our job is to just identify where banks want to buy and where they want to sell at. And then next time price comes into one of these zones, we catch the move. We're basically just piggybacking, we're riding the wave on the way up. Now, one thing that we need to keep in mind is from this example that I just showed you here. Okay, so a bank or an institution, right, first enters the market here. Cool. Let's say they, in total, want to enter, let's say, 900 orders. Okay, cool. So they enter 300 here. Then they're waiting until price returns to this desired level, right? They then enter another 300 orders. Then price comes back down. They enter another 300 orders, okay? So now all of their 900 total orders have been filled. Okay. So eventually, because this cannot go on forever, right? Otherwise, the market would always be moving sideways. Eventually, these zones are no longer going to work. So what I really want you to think about, and we'll go into this a little bit later with the rules and parameters, but each time price taps into your level, it is actually becoming weaker. Now, often, it depends how you trade. We'll look at these levels of like, okay, cool. Price is tapped in once, twice, 3 times. Wow, this is a really strong level. It's really, really respecting it. But it's actually becoming weaker because each time price comes into this level, okay, more orders are being filled to eventually to the point where, as we can see here, it no longer respects the level and it just breaks through. Okay. So yeah, but we will dive into that a little bit more when we go into the rules and parameters. Okay, so how do we actually go about identifying these supply and demand formations on the chart? So I've got the examples here, screenshots of the formations that you're going to be looking for. Okay, so we've got the supply formations, which are right here, and essentially it's the same logic behind all of the formations in the way that we look for an impulsive candle followed by indecisive candles, or sometimes it's just one candle, and then followed by an impulsive candle again. Here, impulsive candle, indecisive candle, and then this was a very impulsive candle on the way down. In this case, we can see that, there was a bit of a wick on it, but in relation to the candles around it, it was still a very impulsive candle. Okay, but we'll go more into this specific example. Then here we can see once again impulsive candle followed by an indecisive candle, impulsive candle on the way out, impulsive candle, indecisive candles, impulsive candle on the way out. Okay. Now we'll go through each of these individually, and the way that you need to think about your formations is you need to look at it in 3 different sections. Okay, you need to dissect it into 3 different things. So the first formations we'll go over are supply formations. Okay, and you'll see that the logic behind all the formations are the exact same, just the way that we identify them is slightly different. So the first and probably the most easiest to be able to identify is this formation right here. Okay, so when price moves up impulsively, it then stops. Okay, so creates an indecisive candle and then pushes down, so breaks out with an impulsive candle. So it basically creates like a top, right? It goes up, it stops, and then it comes down. Now, in each formation, this applies to each of them. You essentially need to look at 3 things. Okay, you need to dissect it into 3 things. So the first thing we look at, right, is the leg in. So the leg in is the impulsive candle, right, that leads to the creation of the base, okay, which we'll go into here. Or in even simpler terms, it's just the impulsive candle before the indecisive candle or candles. Okay, so we can see that here, this is our leg in. Why? Because it's impulsive, and then after that, we see a indecisive candle. Cool. Then we have the base. We just kind of touched on it a little bit, but the base is essentially formed of indecisive candles, or it can be a singular candle, as you can see in this case, right? And it basically creates, in this case, like the top, the surface, the base, okay? And then we have the third and final thing that we need to look at, which is going to be the leg out, right? And this is simply the impulsive candle that essentially leaves from the indecisive candles. So it's the impulsive candle after the indecisive candle, okay? Now we have a few little rules around them, which we'll go into, but first let's take a look at the other formations. Now we have the other supply formation, which is a little bit more rare to come across, but it still definitely does happen, is when price moves down. So what have we got here? We've got an impulsive leg in, right? So it's going to move down, then it creates a base, and in this case we can see that the base is actually created by 2 indecisive candles, right? And then we can see an impulsive leg out. So what does price do? It goes down, it stops, and it goes down again. Okay. Now, just quickly for anyone who isn't familiar with the term impulsive, indecisive. So an impulsive candle, okay, is quite easy to identify, but it's essentially a candle like this, right? A very big candle, but the most important thing is actually the body to wick ratio. So if we take a look at the wicks on this candle, it's almost non-existent. And what that shows us is very clear volume. Okay. And the reason that this is actually important is because it makes our base, the indecisiveness, even more strong or important if you think about it like this, because look how clear this volume is on the way down, and then out of nowhere, it just stops, right? Okay, so that shows that the volume is slightly shifting, but then what happens? Oh, it goes down very, very strong once again, very, very clear volume. So that shows that an institution has entered the market here, because touching on what we spoke about earlier, institutions are the only ones who can really move the market in this kind of way. So yeah, but impulsive, think big candle or small wicks in comparison to the body. And indecisive candle, we're looking at small body and big wicks in comparison to the body. So yeah, just in case anyone wasn't too sure about that. So now the next formations we're going to go over are demand, okay? Now we'll touch into a little bit more, but from demand zones, we're only looking to take buys, and from supply zones, we're only looking to take sells, okay? Not super relevant right now until we go into actually showing you on the charts, but if you're taking notes or whatever, you can just go ahead and put that down. Now, the leg in, the base, the leg out, right? It all stays the same. This is what I mean by the logic is all still the same, okay? So as we can see here, this is essentially what we went over, I believe, the first formation, but it's just the opposite. So instead of it creating a top, it's creating a bottom, right? So we're looking at when price goes down, impulsive down, creates an indecisive candle, right? And then goes up, right? So it goes down, it stops, and then it goes up, right? So our leg in, I don't know why this isn't overlapping, but it's going to be over here to the left, right? You can see here, this is our leg in. It's the impulsive candle before the indecisive candle, so which creates the base. And then we have an impulsive candle on the way out. Okay. So as I said, literally the exact same as what we went over, just the opposite. Okay. Because we're looking for demand. So it's just flipped. So yeah, really, really easy. Now the next formation we've got here is once again demand and the same as supply, just opposite, right? So instead of us looking at it going down, then stop, and then it goes down again, we're instead looking at when price goes up. So impulsive, what's this going to be? This is going to be the leg in, then a base, and in this case we can see it's two indecisive candles, right? And then the leg out, which is going to be this right here. So an impulsive candle after the indecisiveness. Okay. So yeah, I might go ahead and put some like little doc down below, or maybe I'll just send you guys this so you can, look at it instead of like trying to draw it or whatever. But yeah. Okay. Now for the rules, when it comes to the zone, or specifically more the leg in, the base, and the leg out, right? It's actually really, really simple. We have a little bit more technical zones, which we'll go into a little bit later on, but this is really straightforward, okay? So your leg in, which once again, what's that going to be? In this case here, right? This is a demand zone, right? Because we've got it impulsive, right? Then it stops and then it goes up, right? So this is a demand zone. And our leg in, once again, what is it? Well, it's the impulsive candle that prints before the indecision, so for the base. Okay. Now, with the leg in, right, I found that you don't need to be super, super strict with it. You want it to be ideally impulsive, but it's not an absolute necessity. Okay. The main thing that we're looking for is the leg out. It has to be impulsive, and I'll explain why, right? And then the base, pretty simple. It just has to be indecisive. Okay, so indecisive, I literally just mean that, the wick to body ratio, the wicks are much bigger than the body. Okay, it doesn't have to be a tiny, tiny body. That's not what an indecisive candle is. The wicks have to be proportionally bigger than the body itself. Okay, So why is it really, really important that, we see that the leg out is impulsive? This is the most important rule, is because our whole logic, if you think back to what I explained, right, we would mark out a zone here, which I'll show you how to do it. But our whole logic is that, cool, this is where an institution has initially entered the market. And if our assumption is correct, right, if an institution just entered the market here, then, I mean, they're working with billions of dollars, so we need to see some kind of impulsiveness, right? Otherwise, that means that, well, maybe an institution didn't enter the market here. If it's just going up with small little teeny candles, that shows us, okay, well, maybe an institution didn't actually enter here. So that would disqualify the zone. Okay, cool. Let's keep it stepping. All right, cool. So now we're going to hop into the charts a little bit. So yeah, do some practical application. But yeah, let's take a look at a real world example. So here we can identify that we have a demand formation, right? So we have a leg in, indecisive candle, explosive candle out, right? So right here, we have that formation that we went over. Cool. Now, in terms of marking your zones, it's pretty straightforward. What we're going to do is we're going to go ahead and we're going to take this horizontal ray tool, which is what I use. You can use whatever the fuck you want. But yeah, so first thing we're going to do is we're going to mark out the lowest point that price reached within this area, okay? Specifically, I mean the base, and the base is formed of the impulsive candle or impulsive candles, right? So the lowest area that price reached would be here, yeah? Because we can see that, maybe even ting a little bit lower. There we go, cool. So we can see that price wicked down here, meaning that this is the lowest area that price reached, okay? Pretty straightforward. Cool. Now, what we are going to do is we are going to mark out the highest area which price reached within the base. Remember, base, we're just marking out the indecisive candles here. Yeah? Cool. So let's mark out the highest area, which once again would be this wick right here. Cool. So what you now have, okay, this is your demand formation. Well, I mean, it's your demand zone, not formation. Well, it's that as well. But yeah, anyway, demand. That's all that really matters, to be honest with you. So yeah, demand. Okay. So yeah, now we have marked this out. Cool. Now, what we can do, and I'll explain why, is never with the bottom line. Never, 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 never with the bottom line. Okay. This is innegotiable. It has to be the lowest point that price reached, the lowest wick. Okay. However, with the top line, we can decide to either mark out the highest area that price reached using the wick, or we can use the highest body. Okay. So we have a wider version, which is going to be the highest wick, or we have a preferred version, which is going to be the highest body. Once again, you should be taking down notes, or I don't know, yeah, because this is, unless you've got photographic memory, you need to write down this shit so you're actually going to remember. But yeah, wider, preferred. So why do we have two versions? Okay, cool. So essentially, what you are looking at right here is your zone, but you're also looking at your stop loss and your entry. Okay, so what we are doing here is we are waiting for price to come back into this area. So our entry is going to be on the top line. Okay, and our stop loss is going to be at the bottom line. Now, me personally, I like to add a little bit of breathing room, and it saved me quite a few times. If you imagine like 20%, okay? And then we'll go into what you should target. But if we just say, for an example, right here, we're targeting a 1, 2, 2. Cool. Now, if we were to use the preferred version, yeah, then suddenly our 1 to 2 becomes, we get like an extra half R. you know what I'm saying, half an R, right? So yeah, we get more RR, okay, if we use the preferred version. Now, in some cases, okay, the highest wick might be, this big. And then suddenly, what that means for us is, okay, if we're using the preferred version here, right, then what does that mean? That means that price has to go all the way up here for us to get a 1 to 2. And actually, usually we're aiming for a 1 to 3. So, yeah. So price has to travel this far just for us to get a 1 to 3. However, if we're using the preferred version, if we want to get a 1 to 3, well, price only needs to travel this far. Okay. Now, the trade-off is that there is a lower chance that price comes all the way down here before it moves higher, right? Because remember, this, if the wick was like this is our zone, right? And this is our base. So we know that there are resting buy orders somewhere in here, but we don't know where. It could be here, it could be here, it could be here, it could be all the way down here. We don't know exactly where there are resting buy orders, but we know that it's somewhere in here. So if we use the preferred version, there is a risk that price is going to come down, tap into our wider version, and then move, and we miss the move, right? So that is your trade-off, okay? So yeah. Now, it really depends on the situation. If this was the case here, I would most likely use the preferred version. However, as we can see in this case right here, if we were to use the wider version, well, really and truly, between the wider and the preferred, we're not getting that much R, So it just makes sense to be a little bit more conservative, a little bit more patient, and just go with the wider version. So yeah, cool. Now, that rule applies to our supply zone. However, it's going to be the opposite. So in this case, if we're looking for supply, right, then the non-negotiable line is going to be our top line. Yeah, it's going to be the highest point that price reached. And it's not negotiable. You can't move or anything like that. It's always going to be the highest point that price reached. Okay. However, once again, so now it's flipped. Our bottom line can be moved to the lowest body, right? Instead of using the lowest wick within this base, okay, within the indecisive candles, So yeah, and what we can actually see here is kind of interesting is that if we take a look, right, all the way over to the left here, we had a demand formation play out, and never mind, I thought I tapped into it. But anyway, yeah, cool. But yeah, so this right here was actually a demand. This was actually a trade that I took. So if we take a look, price went higher, created this demand level, it then tapped in. As we can see, Corso is tapping into these orders. So if we're correct, price should go higher now, right? And we can see that it did. So yeah, cool. Now let's move into I'm going to show you the other formations. Okay, cool. Now let's take a look at this supply formation. So we just did the demand version of this. It's just flipped now, right? So right now we're on USD CHF. Cool. So this is the process that you want to go through to find a formation. But let's say here, okay, we're looking for supply. So I'm just going to go above this candle to the left, and then I'm going to find the first impulsive candle, which has a indecisive candle next to it. As we can see, impulsive, cool, indecisive, brilliant. Now this is a good example of, is the leg in super impulsive? Well, no, not really, but that's not overly important, and it's still not a weak candle. There's still some good volume. So yeah, however, the leg out is extremely impulsive. Cool. So Now, what we're going to do is we're going to go ahead and mark out the highest point that price reached, and we can mark out the lowest point that price reached. Okay. Now, in this case, let's take a look. If our entry is here, yeah, and we've got some breathing room, cool. We can get a solid 1 to 2 out of this, and in this case, it might be the right thing to do, purely just because, if we're doing the preferred version, let's take a look. Right. If we're doing the preferred version, yes, we can get a 1 to 3 out of this. Okay. However, if we want to guarantee, well, not guarantee because nothing's guaranteed, but if we want a higher chance of getting filled, well, we can use the wider version, and then, we'd be able to probably get a solid 1 to 2 out of this. Yeah, cool. So let's go ahead and see how this plays out. You can see we tapped in, and then we went eventually lower. There you go, lower. And we can actually see here that on the wider preferred version here, that would have been a fucking beautiful entry. So yeah, cool. Okay, cool. Now let's take a look at another formation. So here we are on AUD JPY. And the good thing about this strategy is I've tried it on many different assets. But we'll get into that anyway. Let's just focus on the task at hand. Cool. So what we're going to be looking for is we're going to be looking for the formation where price goes up, stops, and goes up again. Now, this formation is a bit more of a rare occurrence. Most of the trades that I've been taking are off the two formations that I just showed you when we see a clear top and a bottom. But this is also very important to learn. So like for an example right here, what we're going to do, we're looking for demand. So instead of when we're looking for supply going above and to the left, we're going to go below and to the left, and we're going to see the first impulsive candle. Here we can see a fairly impulsive candle. Yes, it does have a bit of a wick on it, but in relation to the candles around it, here it is impulsive. Cool. So then we find the first impulsive candle. Do we see indecisive candle or candles next to it? Yes, we do. So right here, we've just identified our base. Then do we see a leg in? Yes, we do. Cool. So now what we do is we're going to go ahead and take our line. First thing, non-negotiable, mark out the lowest area that price reached within this indecision, within this base. Cool. So I'll go ahead and do that. Now, the wider version in this case, what is it going to be? Well, it's going to be the highest area that price reached. Okay, the highest wick that price reached. Now, our preferred version is going to be the highest body that price reached. So I'll actually just draw them out quickly. Right. So right here, that's our wider and that's our preferred. Cool. Now, the difference between the wider and the preferred are quite significant in this case. If we just measure it out, let's take a look. So if we're working with the preferred here, the breathing room, we can see that, cool, by the time that price has come back up to where it currently is, that will be a nice 1 to 2.5. Whereas if we do this, we can see that if price comes and taps here, this won't even be a 1 to 2, So yeah. But then the risk is, will price come into the wider, tap into orders, and then leave without us? Well, in this case, let's take a look. Let's take a look at what will happen. Let's see if it does tap in to the wider and leave without us. Let's take a look. Okay, so it's actually just tapped into the preferred. So now, based off our logic, it's just tapped into some orders. So we should see a nice move to the upside, and there you go. Just like that. Okay, now let's take a look at the other supply formation, right? So essentially just the same but opposite direction of what we just did. So what we're going to be looking for here is for when price goes down, stops, goes down again, right? Now, oops. Cool. So what we do is we're going to look for the first impulsive candle, which we can see that we're actually on it right now. And then we look above. Do we have an indecisive candle? Yes, we do. It's a good sign. Now, do we have ideally an impulsive candle, which would be the leg in? Yes, we do. Okay, cool. Well, there we have our base, right? I mean, there we have our formation. Leg in, stops, base, leg out. The most important is the leg out is impulsive. Cool. So what do? Let's first mark out our non-negotiable line, which can be the highest area the price reached, followed by, in this case, you're going to use the wider, so the lowest point the price reached, because look at the difference between the wider and the preferred, You might as well just increase your chances that you actually get tapped in. So here we're going to see if price taps back in. If it does, okay, it's just tap back in. You can see that as soon as it taps in, look at how strong it is, guys. Just absolutely goes down and melts. Oh, it comes back. Okay, cool. And then now we can see that it goes down lower. So I didn't actually measure that out, but what would we have got from that? Let's take a look. Cool. I mean, we would have nearly got a 1 to 3. But yeah, cool. Okay, cool. So now let's talk about the rules and parameters of the zones, and then we'll go into like actual showing you guys how I approach the market, so the actual strategy. Let's just go to the chart. I'm bored of this fucking whiteboard bullshit. Okay, cool. So let's talk about violations and when to use a zone and when not to use a zone. To be honest with you, this is pretty straightforward. So the main violation that you're going to be looking for here is when your zone is no longer fresh. Okay, so let's say, for an example, we caught this trade right here. Yeah, so we opened up the chart, which I'm actually pretty sure I did anyway. We can see that price tapped in, cool. We caught a short on the way down. Now, what you will notice is that price has tapped in to this level. Now, how much it has tapped in is really important, okay? If price taps into your level more than 30%, which you can get the measure and like measure it and figure out what 30% is if you want to be really exact, but you can kind of eyeball it. If price has tapped into your level more than 30%, you can no longer trade from this level. Like, bottom line, okay? No if, buts, or maybes. Bottom line, you cannot trade from this level again. Why? Well, think back to what we first spoke about at the beginning of this video. I said that, for an example, let's say, cool, a bank or an institution has entered the market here, and they want to enter a total of 300 orders, and each time, 600 or 900 orders, whatever it was. Each time that price comes into this level, what happens? More orders are filled. The more time that price taps into this level, what does that then mean? The weaker it is becoming, because the more orders are being filled, to the point that eventually price will not respect this level because all of the orders have been filled. Now, we can't know how much orders they've put in, right? We don't know how long the zone is going to be respected for, So the only way that we can kind of combat against that, to make sure that we're trading safely, trading a zone which is still going to be respected, is by making sure we are trading zones which there have not been a large amount of orders being filled from, right? So if we imagine here, cool, prices come in probably around 50%. So a bunch of orders have been filled, which means that it's a higher chance when price comes up to this level again that, it is not going to respect it. Okay, so you can only trade off the same level if, when price comes and taps into this level, it does not do so more than 30%. So when you're looking to find a supply zone to trade off, so for an example here, we go up, we go to the left, cool, we find an impulsive candle followed by this indecisive candle, and here we don't have the most impulsive leg out. However, in comparison to the candles around it, it is still fairly impulsive. So yeah, if we go ahead and mark out the highest point that price reached and the lowest point that price reached, okay, we can see that over here, do we have any violations? Do we have any times where price has essentially come here, wicked more than 30%? No, we do not. So in that case, this zone is fresh and we can trade off it. However, if previously price, for an example, came up and wicked it like this, more than 30%, that is no longer going to be a zone that you want to trade off, and you instead have to find another zone to trade off. Okay, cool. Now let's dive into the actual strategy. And what I mean by that is, I guess, the entry model or my exact process when I'm looking to take these swing trades. Now, I approach each asset class slightly different. So the way that I trade the strategy when it comes to, the NASDAQ or the US 30, and the way that I trade it when it comes to gold and Forex, they're all slightly different. I'll probably make a part two. But I've been using Forex the most with this strategy and actually been seeing a really, really high win rate in recent times. So I'm going to go ahead and break down how you can use this strategy with Forex. I'm going to show you exactly how I caught this Euro USD trade. Now, firstly, I don't actually look at the individual pairs, right? I don't really look at them. I go through from bottom to top. So I'll show you the process. So what you want to do is you want to go to the actual currency indexes, okay? And it's really important that you go to, for an example, 6E1 for the Euro futures, right? And we're looking at the Euro FX futures. The reason that we're looking at the Forex futures is because it's the real price action. It's less manipulated and overall it's just much more accurate. So what I'll do each week is I'll just go through every single one of these and I'll go through this exact process and I'll write it down. And that way I know exactly what I should be looking for going into the next week. So the first thing you're going to do is you're actually going to start on the weekly time frame. So I go over to the Euro FX futures, and on what I'm doing here is I'm looking for the overall trend. Okay. Now in this case, we can see that we're slightly consolidative, as in we're moving kind of sideways. But if we just go back and take a look at, for an example, this low, this high, this low, this high, overall, we can see that we actually are moving lower. This low is lower than this low, so this is a lower low, which is clear characteristics of a downtrend. And I mean, like, you can use the trend lines or whatever you want to do to kind of just map it out even more. Just like that, we can see that overall we are moving lower. Okay. So what does that mean for us? Now, we want to follow the trend, okay? There are very, very unique situations that I might take a counter trend, but overall, we want to follow the trend, okay? So if it's bearish on the weekly time frame, I'm going to be looking for shorts. If it's bullish on the weekly time frame, I'm going to be looking for longs. And if it's consolidative, I'm actually looking for either longs or shorts, but I'm adjusting the way that I manage my position a little bit, which we'll get into. But yeah, cool. So that's step one. I come over here and on the weekly time frame, I see that overall, cool, we are bearish. So on the Euro futures, then what I'm going to do is I'm going to go onto the daily time frame, and here I'm going to go ahead and I'm going to look for the nearest supply level. So I go up to the left, I find an impulsive candle followed by an indecisive candle. You can see here, this is not super indecisive in terms, it's not super small body, but like I said, that's not overly important. What is important is the wick to body ratio. Are the wicks bigger than the body by a significant amount? Yes, they are. Cool. So we can call this an indecisive. We can consider this as a base, right? And then we have a leg in right here. Once again, not super impulsive, but that's, like I said, the main thing is that the leg out is very, very impulsive. Cool. So right here, we have actually identified a supply level. Okay. So just to recap, on the weekly, we know that overall is bearish. I go onto the daily, I look for the closest supply zone, and I can see that, cool, when price comes into this level, on the Euro futures, most likely we're going to move down lower, right? Now what I'll do is I'll move over to, for an example, the dollar. And once again, what I'm doing is I'm going to the weekly first and I'm looking at overall, what is the overall trend right now? Well, we've actually been very, very bearish, but as in recent times, we can see that we are actually making higher highs and higher lows, as we can see right here. Okay, so there's a clear characteristics that the dollar is actually strengthening and the dollar is projected to go high. And then same thing, I go onto the daily time frame, okay, and as on the weekly, it's overall moving higher, so it's projected to go higher. what I'm looking for is a demand zone. So to do that, what I do is I look below to the left. I find the first impulsive candle, and we can see that here we have an impulsive candle, right? Once again, it's not the most impulsive candle, okay, but in relation to the candles around it, it is definitely impulsive. And if we look, at the overall direction from here, it definitely went up much higher. So when I say it has to be impulsive, I do not mean that it has to be a candle like this, right? It just needs to be stronger than the surrounding candles around it. Okay, it needs to have clear direction. Cool. Then I can see a leg in here. And this is a good example of sometimes you're going to have, a little cluster of indecisive candles which actually make up the base. And we do here. So what we do is we mark out the lowest area within this indecisiveness and the highest area within this indecisiveness. Cool. So now what we've got is we've got what you could call an imbalance, right? Or we have what would be the right word? Yeah, I guess an imbalance, right? Between the dollar and the euro. The dollar, we can clearly see, well, the overall trend is projected, the overall trend is bullish and it looks like we're about to tap into this demand zone, so price is going to move higher. And on the euro, overall, we are bearish, so it looks like it's going to go lower and we're tapping into this, it looks like we might tap into the supply zone. So with that in mind, once I've done my analysis, right, going through the individual currencies, Euro USD should absolutely melt. Because for those of you who don't know, Forex pairs, right? Euro USD, that is a hedge against the dollar. So Euro must be stronger in order for Euro USD to move higher. But if it's not, and in this case it looks like it's not going to be, well then we know that it's going to absolutely melt. So then from here it's really, really basic. We do the exact same thing, We go up to the left, we find an impulsive candle, right, followed by an indecisive candle. And we can see here that we have our supply zone. Once again, here the leg in is not super impulsive, but like I said, that's not an absolute necessity and it's not as important as the leg out being really explosive. So yeah, and then we can see that, cool, you can place a limit order here, price tapped in very, very nicely, and then move down lower, and we secured a 1 to 3. So recap on what I just did because it's very, very simple. So quick recap on what I just did because it's very, very simple. I went over to the actual currency indexes, which is where you always want to start. I went to the weekly. I saw, great, it's moving lower. So that means that most likely the dollar is going to continue moving lower. I then scaled in. I went to the daily. I saw that price is about to tap into this supply zone. I then went over to the dollar and I saw that on the weekly, looks like we're moving higher. It's regaining some strength. And on the daily, we're about to tap in to this demand zone right here. So with that bearing in mind, if the dollar is about to tap into a demand zone and the euro is about to tap into a supply zone, then on the Euro USD should absolutely melt. So now all I need to do is go and identify the supply zone on Euro USD, and then I just put in my limit order and I wait for it to play out. Like I said, this is a swing trading strategy. So the main two timeframes that we're going to be using is the weekly and the daily. And that's what I've been doing. And it's been working really, really, really well. So to summarize, with this strategy on Forex, it's all about going to the currency indexes and finding an imbalance, right? Where, as we just saw, the dollar was projected to move higher and it was tapping into a demand zone, which means it's going to move higher. And the euro was moving lower and it was about to tap into the supply zone, so it's going to continue moving lower. With that information, I then know that, Euro USD will go short. And if I went to the pound, for an example, and I saw in the weekly, okay, cool, we're bearish, so it's projected to keep on moving lower. And then on the daily, I come over and I find a supply level. And then on the dollar, I see, okay, cool, we're projected to move higher. and then I find the demand level that it's about to tap into, what do I then know? Well, I know that GBP USD will go short because GBP USD is a hedge against the dollar. So yeah, boys, that's what I've been doing. I've been cooking with it. Going into the new year, I know that I'm going to absolutely eat off this strategy. So yeah, I had a lot of requests to make a video about this. So yeah, that's what I did. Now, obviously, can go much more into depth, and maybe I will. But genuinely, with this alone, if you just go and backtest it, I promise you, you'll be amazed at what type of results that you get. Maybe I'll make a part 2 going into things a little bit more in depth, going into how I trade gold or different assets. But yeah, I hope you boys enjoyed, and let me know if you want more videos like this. I'm going to keep on doing the vlogs, etc. But yeah, cheers, mate. Bye. Oh, and please subscribe.